Hi, welcome. I am Jessica Treader, CFP practitioner and owner of Treader Financial Planning, brokered through LPL Financial. The Outlook is something I've previously offered as a live webinar, but to accommodate for everybody's crazy schedules, I thought I would record it and send it out so you can watch it at your own time this year. So the Outlook is determined by LPL Research. We have a strategic and tactical asset allocation committee, which is an investment committee comprised of all the senior members of LPL Research team, each with their own area of expertise, like equities, fixed income, global economics, and so on. The 2024 outlook is themed around a turning point, a reflection of markets turning to a more recognizable place, a turn more to the status quo, a less stringent Fed, inflation normalizing, and a little bit of a slower growth environment. This turning point for the landscape can be characterized as a return to familiar economic and market patterns and moving toward a steadier environment. So before we start, let's look back at 2023. The economy was surprisingly strong, and stock, in the end, as you all know, probably performed pretty well. But on the downside, there was a regional banking crisis going on, driven by interest rate risk. And then, we all saw the heartbreaking conflict that continues to escalate in the Middle East. Yet those things remind us that markets continue to overcome obstacles. A few quick disclosures before I jump in here. The opinions and statements and forecasts are general information only and are not intended to be specific investment advice or provide specific recommendations for any one individual. And then any forward-looking statements forecasted are just that and may not develop as predicted and are subject to change as market conditions change. All right, so I'm going to cover four broad topics today. I'm going to talk about the economy, which is expected to slow down a little bit after a surprisingly strong year. We'll talk about stocks, of course, which are expected to shift to solid, but not necessarily spectacular returns and follow typical cycles. Bonds are looking like they might get back to normal a little bit, and then geopolitics, which is an increasingly complicated landscape. Looking back at the economy post-pandemic, it grew much faster than expected, and unemployment remained historically low in 2023. But like many other analysts, we also believe that a recession is likely to emerge in 24. Consumers are under increasing debt burdens. Credit card balances are very high. Student loan payments resumed last year. And many folks are depleting their excess savings and just may no longer be able to keep up with those debt payments. So leading economic indicators, things that we're watching that tell us where we are in the economy, but leading indicators tell us what's going to happen next in the economy. And one of those leading indicators to watch this year really closely is an increase in serious delinquencies in consumer debt, credit cards and auto loans. In 2024, the consumer's just not going to be willing to spend quite like they did last year. And consumer spending makes up nearly 2/3 of GDP, gross domestic product. So an end to the spending splurge further supports the base case that a recession is likely on the horizon. However, that doesn't necessarily mean that stock investments are off limits this year. The Federal Reserve is the responsibility of setting interest rates, managing the money supply, regulating financial markets. It's easily the most powerful economic institution in the US, probably in the world. One of its primary objectives is to stabilize the financial system. So we've all experienced the impact of inflation on our wallets. Budgets have been a prime topic of conversation this year. To combat inflation, we saw the Fed increase those interest rates in 22 and 23, nearly 5 percentage points over just a little more than a year, which may be the fastest rate hike in history. The inflation experience also can be quite different for people who are in retirement or who are nearing retirement, simply experiencing losses just by rising costs alone. So a shallow or mild recession would increase the odds that the Fed would cut rates back. And if the economy continues to slow as predicted, that's likely to occur. Markets tend to do fairly well when the Fed pivots and starts to lower. but the magnitude of lowering is unlikely to be nearly as aggressive as we saw when hikes went up. So high rates may actually continue throughout the year. Looking at the job market, there's been a shift in favor of the average worker. In fact, maybe they're in a position of bargaining power better than they've ever been before. They're in a prime position to ask for better pay and more benefits. Some people are calling this the democratization of the workforce. But one unintended consequence of hybrid work, Americans working remotely, combined with high borrowing costs, is that folks aren't necessarily pressured to relocate, which can result in an economy that's less sensitive to interest rate risk. So folks have had a couple years to adjust to this hybrid work model. So we should continue to see a little bit of fair amount of turnover. Of course, the hybrid model only operates in certain sectors, so it's not necessarily consistent across all industries. Some people see the fastest way to higher pay is by switching jobs, changing companies. So regardless, based on the current environment, home prices just probably won't normalize too much. And then a couple forecasts for 2024. GDP, which measures gross domestic product. It's a measure of the monetary value of all the goods and services produced within a country's borders. And then CPI is the consumer price index. So that is the change of prices that consumers pay for a basket of goods and services. So simply put, GDP measures the economy, economic growth, and CPI is measuring inflation. Okay, stocks. What's happening in your 401ks, most of your 401ks this year. Stocks are entering a phase where the focus is going to be on interest rate stability. As inflation continues to come down a little bit, as we expect, this stability should support stock valuations, despite the uncertainty for recession, which could potentially limit gains early in 2024. Stocks essentially priced into this recession back in 2022. The bull is young. The young age of this current bull market, which technically started in October of 22, historically points to gains. So this chart is showing you bull market starts going back to June of 49 and the 12 months that followed that first year. So essentially the second year of a bull market. So of these 12 such periods since 1950, the S&P was positive every single time. And the average gain of those years was 12.6%, which you can see right here. So as the next 12 months, the second year of the bull gets underway, or the next 10 months through October, market history tells us solid gains may lie ahead. A gain of this magnitude seems reasonable given potential support from the Fed as inflation continues to drop down a bit. As I said a few times already, inflation is probably going to still remain somewhat elevated, so high interest rates will remain a threat to both the economy and the stock market, even if they come down just a bit. Stock and bond yields become increasingly negatively correlated, so moving in opposite directions when rates are high, just like they did in 2023. So rates could now present an opportunity because LPL Research believes the 10-year Treasury could be less volatile this year in 2024. Another major factor that drives market conditions is earnings growth, the earnings of a company, which is expected to accelerate as shown right here. So earnings per share, EPS, measures the portion of profit that's allocated to each outstanding share of common stock for a company, or in this example, we're looking at the S&P 500. So LPL Research is forecasting the 2024 S&P EPS at 235 per share, which is up from their previous estimate of 230. If we only get a mild recession, as we expect, and if inflation continues to fall, corporate America should be able to continue beating the earnings estimates. Beyond economic growth, how companies manage the diminishing pricing power, inflation's up, so pricing power is less, is key to the earnings outlook. Reversals of 2023 earnings declines in healthcare and in natural resources sectors, along with increased earnings growth in the tech sector, are going to help drive a turnaround in overall earnings. Stock valuations, by most measures, are relatively high. We measure this on a PE ratio, a price to earnings ratio, the price of the stock relative to the company earnings. So the consensus S&P 500 earnings per share for the next 12 months or the PE ratio is 18.8, which is above long-term averages, which are typically in the 15 to 16 range. Plus, bond yields provide competition for stocks now. So if we're comparing the earnings yield for equities to earnings yields on bonds, you kind of have an equity risk premium near zero, which suggests that equities are fully valued. While earnings growth is likely to help push stocks higher, we anticipate solid but not spectacular returns in 24. So at year end of 23, the S&P 500 was sitting at 4,770, and LPL Research has a year end value target at 4,875. So again, solid but not spectacular. Regarding asset allocation, we're favoring large cap stocks relative to small and mid cap stocks. They're larger and stronger balance sheets, typically have better performance when there's economic uncertainty. If inflation further declines and rate volatility subsides, that also supports growth stocks over value. There's also a demand in AI, which may provide additional support for the growth sector. If you look at sector specific, we are recommending more cyclical sectors like energy and communication. Regionally, we favor US and Japan with an underweight to Europe, since they're still struggling with the high inflation, and then very cautious on emerging markets amid what's going on with China. Moving on to bonds. Bonds, we're expecting to get back to normal trends for 2024. So for conservative investors, 22 was especially difficult with bonds, the worst year on record. In 2023, the bond market was still somewhat impacted by the inflationary pressures. So the turning point for bonds this year is a return to normal, decent returns without having to take excess risk, and a key reason that we believe investors should stick with bonds in 24. We think Treasury yields are going to stay a little bit higher throughout the year. As such, the 10-year Treasury yield could stay in that 3.75 to 4.25 range. So right here is our base case: flattish economic growth and a mild recession, which puts that 10-year Treasury at 3.75 to 4.25. However, we think economic data will soften in 24, which should allow the Fed to gradually adjust monetary policy a little bit lower. But you can't rule out the other two scenarios, either a traditional full-blown recession or a reaccelerating environment. So in the case of a traditional recession, we've priced the 10-year Treasury yield at 3.25. And in a reaccelerating environment, I think I'm covering up this number here, but it's 5.25. We often hear the phrase, history doesn't repeat, but it often rhymes. So looking at interest rates over a longer time horizon is going to give us a little bit more clarity on what could be considered normal for interest rates. So this goes back to 1880 and shows interest rates were in a pretty tight range before the spike of the 1980s. Long-term interest rates mostly have traded within that 3 to 5 year range for nearly a century before aggressively moving higher when the Fed was fighting inflationary pressures in the 80s. Periods that are outside of that 3 to 5 range resulted from the economy's growth and inflation dynamics, which ultimately shapes the Fed's interest rate policy. So a sharp increase that we've seen in the 10-year yield recently puts the yields firmly back into the normal historical range. So with yields getting back to levels that we really haven't seen for more than a decade, we think bonds are attractive again, providing all the benefits of the reasons that you buy bonds: diversification, liquidity, and income. debate from last summer, the Treasury Department has continued to increase the debt. As of September 30th, total debt stood at 33.2 trillion, which is up from 31.5 trillion, which was the number right before Congress gave the Treasury Department unrestrained borrowing capacity, and that goes through January of 25. We expect a sizable deficit over the next decade. The Treasury is going to need to issue additional debt to cover that deficit. So in Treasury bonds, lower yields could make Treasury bonds less attractive, but as long as Treasuries are considered risk-free securities, there are always going to be buyers in that market. Corporate credit, which is what we're looking at on this chart here, has been experiencing a lot of downgrades as well. So the health of the corporate landscape is generally positive, but ratings agencies are starting to adjust their outlooks based on the expected increase in debt payments, among other things. So the rating environment has been relatively calm for investment grade companies, but the lower rated companies, BB plus to CCC minus, have taken the brunt of downgrades. So this chart here is showing you, looking at 2023, and I think this is just through October, but it's the number of year-to-date S&P downgrades and upgrades to corporate credit. So it was already the worst year for downgrades since 2020, with 814 companies downgraded here in the orange, and only 512 that got an upgraded rating. Moving on, geopolitics. You can't look back in history without seeing eras marked by war and conflict. The current climate is no different. The military threat imposed by the Hamas, war in the Middle East, broadening concerns in the ongoing Russia-Ukraine conflict, and China continues to be a concern as we attempt to foster relationships with them with the primary goal of keeping them from acquiring advanced technology for military expansion. While any geopolitical tension has the potential to affect the markets, it's important to remember that these markets are seemingly constantly overcoming these obstacles. Commodity prices have been easing lower as the global economic landscape, particularly China, continues to soften. China's economy has still not fully recovered from 3 years of COVID lockdowns, and they are the world's largest importer of oil. So China's lackluster reopening has likely kept oil price gains somewhat suppressed this year. Precious metals, especially gold, have seen a rise in prices, which indicates that investors are buying them, looking for safe havens. The dollar is stronger compared to foreign currencies because of favorable interest rates, but it's overvalued if we're comparing it to the yen, euro, and the British pound. The yen is the weakest of the developed market currencies. The US dollar is clearly very expensive on a historical and relative basis. There's at least some value in holding foreign assets in the longer term, but until we see a persistent shift forward towards a synchronized global growth and central bank tightening, foreign currencies as a whole are likely going to struggle to meaning. Okay, so that's all of it. A couple of key takeaways. The economy, we're looking at a mild early to mid-year recession in 24, less consumer spending, so slower GDP, and we expect to see rates start to hedge down. Stocks, we're expecting high single-digit returns for the S&P due to solid corporate earnings, muted stock market reaction to the recession. Bonds, an ease in interest rates could make it a good market for bonds. Core bonds look very attractive relative to the other sectors of bonds, and preferred stock is another attractive way to find fixed income right now. Geopolitics tension will persist, but may not necessarily shake markets too much. And then we have a US election this year, which I haven't even discussed. I'm going to dive deeper into that with the mid-year outlook, as it'll be a little bit more timely later in the year. So as always, I'm available to you guys. If you have questions or comments, feel free to shoot me an email or give me a call. And I've got a couple disclosure slides to walk through here. But have a great year, a very happy, healthy, wealthy 2024, and I hope to see all of you very soon.